Hello everyone. Welcome to Stock Tracker, an ultimate hub for the stock market and its dynamics. In the very first video, I'm going to talk about the most important aspect of the stock market, and that is nothing but the psychology to build a positive progress and not the negative number growth. Before I jump to the main topic, I would like to take your attention to the quote by famous stock market investor Mr. Warren Buffett. He states that the key to success is the emotional stability. And this video is rightly centered at the same topic, that is, a balanced psychology for the stock market. Now, let's directly take the subject to the core. The important part for money investing is the decisions taken by investors, or for that matter, decisions taken by an individual investors, which is this video is focused on. These decisions are highly impacted by the age of the investor, his or her education, the money they make, that is their income, and their current portfolio, if at all they are already in the stock marketing business. Technically speaking, decisions are nothing but taking a right direction at right time from combinations of options available. So when we speak about the choice, we need to make sure we know the basics of all those options. So yes, the knowledge and information is must before you jump onto any decision you take during your money investment. Then comes the four major key qualities or attitude we must possess before taking the stock market related decisions. First key quality is positive attitude. No matter how badly our portfolio got impacted, whether you reached your goals or not, you have to keep your mindset positive. The second one is foresight. We must foresee the impact of our decisions. Then the third comes is perseverance. We should able to continuously pursue our goals and to achieve all in positive numbers. Lastly, you need to have a strong drive for it. On top of these main qualities, there are certain factors that impact your decisions, which are the demographical differences like social, economical backgrounds. For example, A person makes 1 lakh per month and B person makes 20,000 per month. So this is a demographical difference. Then another demographical difference could be the educational level. A person might be SSC, or he or she may be a degree holder. Someone could be a degree holder in finance or economics. And you understand here that they impact drastically on your investment decisions. Other factors like age, gender also contribute to investing decisions. This is definitely a subject of detailed discussion, but I'll keep it brief here and limit to only psychological aspects for successful stock market investment decisions. Now let's see whether decisions can be universal or not. The answer is clearly no. There are no universally correct decisions when it comes to a stock market. The research analysis on stock market investment clearly suggests that a decision taken by investor 1 may not necessarily be the right decision taken by or taken for the investor 2. And why this is so? Because these two investors may or may not differ by investment objectives. Someone might want to make 70,000 from 50,000 investment. Someone might want to see it grow to 80,000 or 90,000 or so. Then their risk tolerance will be surely different depending upon their economical social background. Their money inflow and outflow will be different too. And finally, their financial responsibilities will be different. So the message here is decisions should be different, or they will be different for different investors. However, there is a shade to stock market investment that is quite commonly observed in the investors' decisions. They often forget or ignore the fundamentals and the basic analysis and fall prey to their emotions and fear. and finally end up taking silly decisions which make their portfolio go in negative numbers or red numbers. Therefore, a lesson here is the decisions that have strong influence of emotions like greed and fear is bad decision for the money investment. After the emotions, the bad investment decision is mostly comes from second level of technical aspect, which is misinterpretation of the fundamental information, then by allowing to be taken over by the thought that they are smartest than others, and eventually responding in the excited state to the market swings, thinking that they will become rich overnight, or the other way, they will come to the road overnight. Thus, one must be rational, logical, based on the knowledge and information of the particular stock they are making the decision for the investment. And being irrational is simply a road to steep valley, which in no time will take you to the red numbers. Finally, to summarize briefly, the message of this video is rationalize your thought process. Don't let your emotions overtake you. Don't take decision in a hurry by looking at someone else or listening to someone else unless there is a strong substantial rationale to it. And finally, the decision for your money investment must be taken by yourself based on the information and the knowledge for your money investment. Now, just before wrapping up, I give you a simple test before you make the investment. So just rate yourself on the scale from 0 to 10 for the parameters like emotional level, tolerance level, return level, time period level, analysis and information level, and finally the confidence level. When it comes to the emotional level, you have to be below 5. 0 means you are not at all emotional while taking the money investment decisions. Above 5 means you are too emotional. So you have to decide yourself that while taking the decisions at what level is your emotion is. It has to be below 5. Then tolerance level. Tolerance level is something that you can tolerate to have your portfolio in negative numbers. So it could be minus 20%, it could be minus 30, it could be 40 or 50 for someone else. So you can put that into your tolerance level scale. Then comes the return level. So how much you're expecting from your investment. You could expect from 5, 10%, 20%, 50%, 20%. And of course, this return you can expect in a certain period of time. So that can falls into time period level. So it could be 1 year for someone, it could be 2 year, it could be 3 year. So that you can put into time period level. Then comes the analysis and information level. So you make sure you have to ask yourself whether you have analyzed, you have read all the information of the particular stock, and based on that you can rate there. It has to be above 5 as the analysis and information is must before you invest your money. So based on all these levels you can put your confidence level. Of course, the confidence level 8, 9, 10 are suitable levels before you make your investment. Yeah, so this is all in this video. So finally, I thank you all for listening to me, and I wish you best for